In the towering skyscrapers of Wall Street, a system has been perfected over centuries. It's a world of gatekeepers, intermediaries, and complex rules, where fortunes are made and lost within a closed ecosystem. For generations, this has been the undisputed heart of global finance. But what if a new financial frontier was emerging, not in a physical city, but in the digital ether? A world built on code, where the rules are transparent, the gatekeepers are algorithms, and anyone with an internet connection can participate. This isn't science fiction. It's the radical promise of decentralized finance, or DeFi, and it's fundamentally challenging everything we thought we knew about money and investment. To date, we're going on a deep dive to uncover the disruptive investment opportunities that DeFi offers and how they stack up against the traditional financial world we've always known. At its core, decentralized finance is a parallel financial system built on blockchain technology. Instead of relying on banks, brokers, and insurance companies, DeFi uses smart contracts, self-executing pieces of code to automate financial processes. This simple, yet profound shift eliminates the need for many of the intermediaries that dominate traditional finance, or CIF. This technological foundation doesn't just create a more efficient system. It unlocks entirely new categories of investment opportunities, creating a landscape that traditional finance struggles to replicate. The differences are not merely cosmetic. They represent a fundamental paradigm shift in how we interact with control and grow our capital. One of the most profound distinctions lies in the concept of autonomy and control over your assets. In the traditional system, when you deposit money into a bank, you are essentially ceding control. You trust that the bank will safeguard your funds and honor your withdrawal requests. Your assets are entries in their ledger, subject to their terms, their hours of operation, and their potential institutional risks. In DeFi, this relationship is inverted. You maintain absolute control of your assets through the private key of your personal digital wallet. This is your vault, and you are the only one with the key. This structure drastically minimizes counterparty risks, the danger that the other side of a transaction will fail to fulfill its obligation. It also mitigates the risk of your account being frozen or funds being seized without due process, a power traditional institutions hold. Every transaction is recorded on a public, immutable ledger, the blockchain offering a level of transparency that is simply unheard of in the opaque corridors of conventional finance. This new architecture has given birth to unique investment opportunities that are either completely unavailable or prohibitively complex and expensive in the traditional world. Let's start with one of the most foundational pillars, lending and borrowing. If you need a loan from a bank, you're in for a long process. It involves credit score checks, income verification, and extensive paperwork to assess your creditworthiness. In DeFi, this process is reimagined. Lending and borrowing transactions are nearly instantaneous and accessible to anyone, regardless of their credit history or geographic location. Instead of relying on a credit score, loans are secured by digital assets. A borrower locks up collateral, like Ethereum or a stablecoin, into a smart contract, and in return, they can borrow other assets against it. This entire process is verified by cryptography, not by a loan officer. This dramatically reduces counterparty risk and slashes the administrative costs associated with traditional credit. It's creating a more efficient and open market for both lenders and borrowers. Lenders, in turn, earn interest on the assets they provide, often at rates far more competitive than a standard savings account. Beyond simple lending, DeFi introduces more dynamic ways to earn passive income, concepts that have no direct equivalent in CEF. One of the most popular is liquidity providing and the subsequent practice of yield farming. On decentralized exchanges, or DEXs, trades happen directly between users' wallets, facilitated by liquidity pools. These pools are vast reserves of paired tokens supplied by investors, known as liquidity providers. By depositing their assets into a pool, say for an ETH-USDC pair, these providers facilitate trades for others. In return for providing this crucial service, they receive a portion of the transaction fees generated by that pool. This creates a steady stream of passive income, turning idle assets into productive capital. Yield farming takes this concept a step further. It's the intricate art of moving capital between various DeFi protocols to constantly chase the highest possible yield. Measured in APY or APR, A sophisticated yield farmer might deposit an asset into a lending protocol to earn interest, use the interest-bearing token they receive as collateral on another platform to borrow a different asset, and then supply that borrowed asset to a liquidity pool to earn trading fees. This complex, often automated strategy of stacking yields is a dynamic and higher risk, higher reward activity that the siloed and slow-moving world of traditional finance simply cannot offer. It is the financial equivalent of a high-speed digital treasure hunt. The engine room for much of this activity is the decentralized exchange, or DEX. While centralized exchanges like Coinbase or Binance have onboarding ramps from traditional currency, they still operate as trusted third parties, holding your funds on your behalf. DEXs like Uniswap or Curve operate differently. They enable direct peer-to-peer trading, meaning your assets never leave your personal wallet until the moment a trade is executed. This non-custodial nature is a major security advantage. Furthermore, because DEXs run on automated smart contracts with minimal human oversight and physical infrastructure, they often feature significantly lower transaction fees compared to their centralized counterparts, which have to cover costs for staff, security, and corporate overhead. DeFi is also innovating on the very nature of money and risk management. Decentralized stablecoins are a cornerstone of the ecosystem. These are cryptocurrencies designed to maintain a stable value. It's typically pegged to a fiat currency like the US dollar. While some, like USDT, are backed by centralized reserves, a new generation of decentralized stablecoins maintains its peg through algorithms and collateral locked in smart contracts, creating a form of digital cash that is censorship-resistant and can be transacted globally with ease. Alongside this, the concept of decentralized insurance is taking root. Protocols like Nexus Mutual allow participants to pool capital together to offer coverage against specific risks, such as smart contract failures. By disintermediating the traditional insurance company, risk can be distributed among a community of participants. It's potentially leading to more accessible and lower-cost premiums without the administrative bloat of a legacy insurer. Perhaps the most powerful and abstract advantage of DeFi is its interoperability and composability. Think of DeFi applications as financial Lego bricks. Because they are built on open-source code and shared blockchain infrastructure, they can be seamlessly connected and combined in countless ways. A lending protocol can interact with a decentralized exchange, which can then be integrated with a yield aggregator, which might then plug into an insurance protocol. This allows for an exponential rate of innovation. Developers can build new products by leveraging existing ones without asking for permission. In traditional finance, this is nearly impossible. Banking system. I cannot easily and flexibly connect with brokerage system B or insurance system C. Each operates in its own proprietary, closed-off infrastructure, making deep integration a bureaucratic and technical nightmare. This leads us to the philosophical core of DeFi. It is permissionless. To participate in the traditional financial system, you need permission. You need a bank account. You need to pass KYC, know your customer checks, and you may need to prove your income or net worth. DeFi, in contrast, is open to anyone. All you need is an internet connection and a digital wallet. It doesn't ask for your name, your nationality, or your credit score. This ethos of financial inclusion has profound implications, potentially opening up sophisticated financial tools to billions of people around the world who are unbanked or underbanked by the current system. However, this new world of radical freedom and opportunity is not without its perils. The very features that make DeFi so powerful also introduce new and significant challenges. The autonomy it grants comes with immense responsibility. In DeFi, you are your own bank, and that means you are also your own security. The risk of smart contract failure is ever present. A single bug or exploit in the code of a protocol can lead to the instantaneous and irreversible loss of all funds deposited within it. The markets are also incredibly volatile, and the use of leverage in lending or yield farming introduces substantial liquidity risk. A rapid market crash can trigger a cascade of automated liquidations, wiping out a user's collateral. And crucially, there is currently a lack of a comprehensive legal framework. Unlike with a traditional bank, there is no FDIC insurance to protect your deposits, or a legal system to easily recourse if something goes wrong. Ultimately, the rise of DeFi represents more than just a new set of investment tools. It's a fundamental reimagining of the financial landscape. Trades the perceived safety and familiarity of the old world for the unprecedented autonomy, transparency, and innovation of a new one. While traditional finance offers a well-trodden path guarded by established institutions, DeFi presents a rugged, open frontier filled with both immense opportunity and significant risk. The choice between these two worlds is a choice between trust in intermediaries and trust in code, between a permissioned system and a permissionless one. As this technology continues to evolve, it will force us all to reconsider not just where we invest our money, but the very principles upon which our financial systems are built. The digital revolution in finance is here, and it's just getting started.